Hi, Assalamualaikum warahmatullahi wabarakatuh. Good morning to my fellow teammates, and it seems that we have received a new case study. So let me introduce you and discuss it. We have the Mila Co company itself. It is actually manufacture the fizzy drinks. It's all about the soft drink. We have the cola drink, we have the lemonade drink, and other soft drink. When we talk about the trading result for the Mila Co, actually, it is very good standing in the financial statement itself, and it is actually forecasting the revenue um, from the last year itself, but it seemed that the revenue itself increased for 85 million ringgit. But the expenditure actually more to the 5 million ringgit in preparing to the updating the products, in repairing the machinery itself, and also to replace all the machinery. So when we talk about the number of production increase, the Mila Co company actually expand the number of warehouse to the store inventory. At the bottom of the slide here, we have the Mila Co company actually utilize 15 warehouse, and some owned by the Mila company and some rented by third party. The Mila Co business actually introduced a new accounting ledger, which is introduced at the beginning of the year, and the new and the old accounting ledger is run in parallel for 2 months. We believe that Mila actually thinking about to develop and produce a new development brand of fizzy soft drink, and it's actually incurred expenditure 4.5 million ringgit, and it is actually being started in the process starting in the July 2004. The increase in revenue, and the management itself actually recruited a new credit controller. This is the recruited new credit controller the Mila company do in order to chase the outstanding receivable, because the money itself it belong to the Mila company, and it is actually released the opening allowance for 1.5 million to the scene, and it is actually happened in the April itself. The mixing of the raw material within the production process. As a result, this means as a result, a large batch of the cola product tastes different. When the Mila company sold all the product, the number goes increase, and the customer start to complain about it because of the taste itself, and thus not resulting in the revenue for the company, for the Mila company, and no further sale itself for the Mila company. So the no adjustment made to the valuation of the damaged inventory. It will be annual bonus also, as in the previous year. The management of Mila Co company is due to pay a significant annual bonus based on the valuation of year and total asset.
Hi, my name is Nur Fadato. So before we go into depth into the problem and solutions of Mila.co, we first need to know what is audit risk. So audit risk is defined as the risk that the auditor express inappropriate audit opinion when the financial statements are materially misstated. Audit risk is a function of risk of material misstatement and detection risk. So, and what is risk of material misstatement? So, risk of material misstatement is the misstatement that in the financial position prior to the audit, which it has two components, which are inherent risk and control risk. So, what are the relationship between inherent risk, control risk, and detection risk? As you can see here in the diagram, firstly we have inherent risk. So, inherent risk is a misstatement that likely to occur in client financial statement. So, here in the diagram we can see that, for example, we can say that you want to take a walk, and then suddenly what are the risks that you may face when you are walking? So it may get rain. So rain are the inherent risks that we need to face here, something that we can predict. So next is control risk. So what is control risk? Control risk is a misstatement that bypass control or are not detected by control. For example, you want to take a walk and then it's raining and then you prepare an umbrella. However, the umbrella is broken or tear apart. So the umbrella being broken or tear apart is the control risk, something that we can do or with something that we can control even though we have our internal control. So lastly is detection risk. Detection risk is material misstatement not detected by audit procedure. So even though we already perform audit procedure, the risk may not be detected. So now we need to see what is the differences between inherent risk, control risk and detection risk. So even though inherent risk and detection risk are the components of risk of material misstatement, there are distinct difference between inherent risk and control risk. So inherent risk stem from the nature of the business transaction or operation without the implementation of internal control to mitigate the risk. Meanwhile, control risk arise because an organization doesn't have adequate internal control in place to prevent and detect the fraud or error. So, risk of material misstatement is the risk that the financial report are materially incorrect before the audit is performed. For example, there is inventory cost $1 million, but it was incorrectly recorded as $100,000. So, when the stakeholder read the financial statement and it found the mistake, it is considered as material. So, the mistake happened because there is belief that there is insufficient of internal control. So lastly is detection risk. Detection risk is the risk that the auditor's procedure do not detect a material misstatement. So for example, if an auditor want to check on the inventory count, so they use a physical count and compare it with the accounting record. So in order to do that, the auditor need to pick a sample. However, if the auditor's test sample of the inventory count is insufficient to extrapolate the whole entire inventory count, the detection risk will be higher. So, detection risk is inversely related to the risk of material misstatement. For example, when inherent risk or detection risk are assessed to be high, the detection risk need to be low. It is because in order to reduce the audit risk to acceptably low level.
Hello, I'm Mahdini. So I will explain about 7 audit risks and the auditor's response to each risk. The first risks are regarding of Mila's core company expenditure. So the risk is it should be capitalized as a part of PPE, which is plant, property and equipment, if this expenditure is of a capital nature. If it relates more to maintenance, it should be expensed to the statement of profit or loss. Profit and PPE could be under or overstated if the expenditure is not correctly classified. So, auditors should review a breakdown of this cost to make sure the split of capital and revenue expenditure. Further testing need to be done to ensure that the classification in the financial statement is correct. The second audit risk is, at year end, there will be inventory counts undertaken in all 15 warehouses. So the risk is auditor cannot possibly attend all 15 inventory counts. So any warehouse that was not visited, sufficient appropriate audit evidence over the inventory counting controls and completeness and existence of inventory must be obtained. Auditor should assess which of the inventory sites they will attend the counts for that have a history of significant error. Those that not visited, auditor should check the level of exception recorded during the count and discuss any issues that occurred during the count with management. The third scenario are, within 15 warehouses, some are owned by Mila and some are rented from third parties. So, under PPE, only warehouses operated by Mila should be included. There are risks of PPE overstatement and understatement of rental expenses if all 15 warehouses have been capitalized by Mila. So, auditors should review supporting documents for all warehouses included within the PPE to confirm Mila's ownership and to ensure that non-current assets are not overstated. Next, a new accounting general ledger system has been introduced at the beginning of the year. So, there is a risk of misstated opening balances and loss of data if they have not been correctly transformed from the old system. In addition, documentation will be needed for the new accounting general ledger system, and the controls over this will need to be checked. So, auditors should carry out a detailed test to confirm all opening balances have been correctly recorded in the new accounting general ledger systems. Review any management reports to identify any accounting information issues. Next scenario are the expenditure of 4.5 million on developing a new brand of fizzy drinks. So the research cost should be expensed while the development cost should be capitalized as an intangible asset. There is a risk that an intangible asset could be overstated and the expenses could be understated. So the auditor should obtain a classification of expenditure and conduct testing to determine whether the cost related to the research or development stage. Next, a large batch of cola product has been damaged. Therefore, customer have been complained. Mila Co need to refund to customers for the damaged goods sold. The risks are the revenue is possibly overstated if the sales return are not completely and accurately recorded. So, auditors should review the breakdown of damaged goods sales to ensure that they have been accurately removed from revenue. Lastly, the management of Mila received a significant annual bonus based on the value of year-end total assets. So the risks are, the management might feel under pressure to overstate the value of asset through the judgment taken or by releasing provisions. So auditors should make sure that the team maintain professional skepticism during the audit. The auditor should closely review the judgment taken to compare the treatment with previous year.
Other than audit risk, there are many areas that should be emphasized in generating the audit strategy document for Milaco. One of the strategies is Milaco and auditor should achieve a good understanding and agree towards each other's policy. Both of them must develop a term of engagement and outlines each responsibility to avoid any misunderstanding in the future. This will determine that Milaco had agreed that the audit firm can be independent in providing the conclusion for their report, and the audit procedures done by the auditor is compliance with the Professional Code of Conduct and Corporations Act. The audit firm also must understand wholly about Milaco's business and the industry to ensure that the auditor can provide a correct framework for Milaco's based on the nature of the business. Next, another strategy that should be included in the audit strategy document for Milaco is auditors should choose the most appropriate method in performing the audit procedures. This will ensure that each method chosen by the auditor in the audit procedure is effective and efficient to reduce the risk of material misstatement in the report letter. The final work done by the auditor also will be completed in the right approach. For instance, auditor must choose the best sampling method in obtaining the evidence based on the nature of the business and the objectives that the company wants to achieve. This will ensure that the sampling method chosen by the auditor is sufficient to obtain evidence and reflect the whole population without being biased in selecting the sample. Besides, auditor may decide to incur any audit software computer like CATs to help them in the audit procedure to provide the conclusion for the report. Other than that, auditors should portray professional judgment in all of their decision making in providing the final conclusion for Milaco's company. Audit independence is the key component in the process of auditing, and agency theory that makes the audit function can be seen separated from the management and underlies the credibility of auditing profession. For instance, auditor must indicate the ability of Milaco to continue their operations in foreseeable time and advise them in any part that involve in the going concern issue. Auditor also should maintain the skeptical mind and be suspicious if there is anything that triggered the amounts shown in the financial reporting between years and exercise professional judgment in evaluating the audit evidence. This includes the use of internal auditor in evaluating the management's operation that may have a high risk of not being independent, and the use of others that expert in any part of the audit procedure. So, the external auditor must examine carefully the work of others to ensure the effectiveness of the internal control that will reduce the audit risk.